Right now, a silent wealth tax is eating away at the contents of your wallet, and if you are hoarding points and miles for a rainy day, your balance just took a massive hit. The rules of the credit card game have officially shifted. The major credit card issuers have quietly initiated some of the most aggressive devaluations we have seen in a decade, stripping away premium benefits, increasing annual fees, and slashing the value of the points you have already spent years earning. For years, the golden rule of award travel was simple: 1 bank point equals 1 airline mile. That era is dead. If you don't adjust your credit card strategy immediately, you are essentially paying a luxury premium for a hollowed-out piece of plastic. Let's look at the cold, hard numbers of the 3 major devaluations hitting your wallet this year, and the mathematical workarounds you need to deploy right now to keep your rewards at maximum value. The first and most damaging devaluation is the destruction of the 1:1 transfer ratio standard. Flexible point currencies like American Express membership rewards and Capital One miles have always been valuable because they act as financial chameleons. You can move them to various airline partners at a clean 1-to-1 exchange rate. Not anymore. Capital One officially slashed its transfer ratio to Emirates Skywards down to 1 to 0.75. That means 1,000 Capital One miles now yield just 750 Emirates miles, a literal 25% overnight haircut. American Express quickly followed suit, dropping its Emirates transfer ratio to 1 to 0.8 and cutting its Cathay Pacific Asia miles transfer ratio down to a brutal 5 to 4. Let's look at the math on a practical scenario to see how this hidden tax destroys your buying power. Say you want to book a business class ticket from New York to Europe via Emirates, which costs 102,000 airline miles. Think about what that actually means for your wallet. If you earn an average of 2 miles per dollar spent on a premium card, that 34,000-mile Capital One penalty means you now have to spend an extra $17,000 on your credit card just to bridge the gap for the exact same seat. The banks are forcing you to spend thousands of dollars more to get the exact same return. The workaround. First, stop hoarding your points like a high-yield savings account. Points do not earn interest. They only accumulate inflation and devaluations. Earn them and burn them. Second, pivot your spending toward ecosystems that are fiercely protecting the 1:1 standard. Chase Ultimate Rewards has publicly held the line on its 1.1 ratios across all transfer partners. If you are looking to book premium international flights, shifting your daily spend from a devalued ecosystem over to Chase or even Built Rewards protects your purchasing power from a sudden 25% drop. The second major devaluation hitting the market is the massive inflation of annual fees, coupled with the couponification of premium cards. Premium cards have historically charged premium fees, but issuers have recently raised the stakes. The market has seen flagship premium cards climb from $695 up to $895, while competing luxury travel cards have jumped from $550 to $795. To justify these sky-high price tags, banks claim they are adding more value by stuffing the cards with statement credits, like $10 a month for a specific food delivery app, a credit for a digital streaming service, or a gym membership subsidy. But this is a psychological trap designed by bank actuaries who rely on a metric called breakage. Breakage is the industry term for when a customer pays for a benefit but forgets to use it. Let's look at the math nerd reality of holding an $895 card packed with $1,000 worth of miscellaneous credits. If you only naturally use $400 of those specific credits, your net calculation looks like this. You are paying the bank a $495 premium for the privilege of tracking monthly chores. If you change your lifestyle, alter your shopping habits, or buy things you wouldn't normally purchase just to use up a credit, you aren't saving money. You are falling victim to a targeted corporate spending push. A quick reality check. The banks spend billions of dollars designing systems to keep you tracking coupons while they quietly devalue your hard-earned points. If you want to stop leaving money on the table, cut through the banking noise, and master the actual math of personal finance, hit that subscribe button right now. We break down the real numbers every week so you can keep your money where it belongs, in your pocket. Now let's get into the final, and most aggressive, devaluation happening at the airport terminal. The third major devaluation targets the physical perks of travel: airport lounges. The era of buying a premium credit card and enjoying unlimited luxury lounge access for you and your friends is officially over. Because airport lounges have faced unprecedented overcrowding, card issuers are deploying aggressive gatekeeping tactics to thin out the crowds. Capital One completely eliminated complimentary guest access for its core luxury cardholders at its flagship lounges. If you want to bring a travel companion or a spouse inside, you now have to pay an extra out-of-pocket fee per visit. Meanwhile, major airline-branded premium cards and luxury issuers have placed hard caps on lounge visits, limiting cardholders to between 6 and 10 visits per year. Once you hit that ceiling, you are locked out unless you spend an astronomical amount of money on the card. For example, to unlock unlimited lounge access or guest privileges on certain ultra-premium cards, you are now required to spend a staggering $75,000 or more in a single calendar year on that specific card. Let's look at the opportunity cost of doing that. By forcing $75,000 of everyday spend onto a single card just to get into a lounge, you are sacrificing up to $2,600 in premium rewards that you could have earned by using optimized 3x or 4x category cards on dining, groceries, and gas. You are effectively paying thousands of dollars in lost rewards for free salad and a quiet seat before your flight. The workaround. It is time to mathematically downgrade your luxury travel cards and shift to a mid-tier plus priority pass strategy. Instead of paying massive annual fees for restrictive lounge access, downgrade to an agile $95 or $150 mid-tier card that focuses entirely on pure multiplier point earning. Then, if lounge access matters to you, look into standalone lounge memberships or specific independent cards that still bundle Priority Pass select access without demanding high spending thresholds. Stop letting the banks dictate your financial habits through artificial luxury barriers. The credit card landscape is changing fast, and the old advice of simply holding a premium card and hoarding points for a decade will cost you thousands of dollars this year. Protect your wealth by prioritizing flexible, non-devalued ecosystems, auditing your annual fees against your actual utility, and refusing to chase high spending thresholds for hollowed-out perks. And if you missed it, make sure to check out our previous video where we broke down the massive Chase Sapphire Reserve 150,000 point bonus and exactly how to extract maximum value from it before the rules change again. Tap that subscribe button, watch the Chase breakdown next, and I'll see you there.